Welcome back, traders and investors. We have Michael Pachter on the line, research analyst at Wedbush Securities. Michael, how you doing on this Monday morning?
I'm great, Joel. Thanks for asking.
Okay, so we talked to you about a lot of different stocks, and we just came off a quad expiration, and the market seems to be holding up pretty well here. Looking at some of the issues that you cover, I guess the one that people are probably most interested is Amazon here. It's hit some resistance. You got a neutral rating and a 330 price target. So, what's your current outlook for Amazon?
You know, probably it's my favorite company as a customer, and I completely understand how people could, love the stock and think it's going to triple. But I think that, we really need to factor in that there's a strategy here that hasn't been articulated very clearly to investors that, Amazon wants to dominate retail. And I think that beyond retail, they also want to dominate the delivery of media to various devices. So, they've just launched or they just announced their third device. It's obviously a cell phone, so it does more than just, receive media. It's obviously a communications device as well. But I think that if you look at Kindle, that kind of morphed from a e-reader into a full-blown tablet. You look at Fire TV, which looks like it's positioned for streaming of both video and video games. And now you look at the Fire phone, you can see that Amazon's got an overarching strategy to kind of insert itself into the process of delivering media. And I think that that's a very costly proposition. My estimate is that they're spending about $1.5 billion annually on content for Amazon Prime Instant Video. And if you kind of parse through how much money they're making from Amazon Prime, they probably have about 25 million users, and they're collecting $100 a piece. So sure, they're collecting $2.5 billion. That offsets the cost of the content, but they also have to ship all those people stuff. So the shipping costs are very likely higher than the $100 of gross revenue received for the Prime membership. And the $1.5 billion they're spending on content is being essentially subsidized by Amazon and its shareholders for the very few of the 25 million people who actually use it. I think that most Prime members are pretty wealthy. You wouldn't join Prime unless you anticipated shipping at least $100 worth of shipping costs, or incurring at least $100 worth of shipping costs. So they're probably upper income households. I would imagine 80 or 90% of the Prime members are above the median household income, and those people are very likely to be Netflix customers if they care at all about streaming video. So Prime Instant Video doesn't have a lot of appeal to them. Amazon's beefing it up with their most recent HBO exclusive deal. We estimate that's about $375 million annually. And again, notice it's an exclusive. So I think that Amazon's going to continue to kind of flush profits as it invests in building out its media presence. It invests in building up its Prime membership to drive higher retail sales. And really simply, I'll make this really easy. If you roll back to 2010, Amazon made just about $1 billion on $24 billion in revenue. If you look at 2014 and you look at consensus estimates, they're going to make a little over $1 billion on about $90 billion in revenue. So these guys have had over $60 billion in revenue growth, and they aren't making any money on that incremental $60 billion. If you look at their gross margin, it's gone up. So they're literally investing $12 to $15 billion a year more this year for the year than they were back in 2010. What are they spending that 12 to 15 billion on? Well, 10% of that is content for Amazon Prime Instant. A lot of it is shipping for Prime members. A lot of it is building out Amazon Web Services. A lot of it is building out distribution centers. So my very long answer to your very simple question is, I think that it's hard for an investor to make a call that Jeff Bezos is done reinvesting in the business until there's evidence that he's done. I think this thing is a perennial neutral until we see that they're serious about making money. I think they're positioning the company to make a ton of money, but just not this year. So I think your money is better invested elsewhere. I don't think it's a short. I have 3 sells, so I know how to say sell if I don't like a stock. I think this is truly a neutral. I've been at 330, the stock, for over a year. The stock has gone up, it's gone down, it's come back. It's kind of hovering around that
Yeah,
price,
I noticed
and
that.
I just don't see it going much higher. And I can't even tell you what the right valuation is. You have to kind of assume someday they're going to turn on the earnings taps and we can discount that back. I assume that's sometime in the next 5 years. So this is a great investment if you have a kid's college fund. I think that's fine as long as your kid is still in elementary school. I don't think it's a great investment if your kid's a senior in high school.
Okay, so it's a flawed strategy, but you're going to give it time to
Oh,
work out.
I think it's a smart strategy. It's just that they won't make profits for a while. So nobody would begrudge Bezos spending all this money if he grows revenues to $200 billion and he's suddenly making 10% operating margin. They're going to love this company, and I think that's probably what you're going to see. You're probably going to see a company making $20 billion of profit on $200 billion in revenue because I think he's building something to last. It's just that they're not going to deliver that in the next year, and I have a 1-year price target.
Okay, Activision Blizzard, you have outperform, and this stock has had a real nice run. But as of June 5th, you still have a $30 price target on Activision Blizzard. How are they gonna? What are they gonna do to reach that target?
I think they'll just drift there this year. I mean, if you look at the stock for the last several weeks, it's literally up pennies a day every day. They're doing everything right. I think the right way to value them is to look at them and compare and contrast them to Electronic Arts, which I also have an outperform on. EA's gone from a low of 11 to 37. It's literally doubled in the last year. Activision has not doubled. Activision is up about well, I mean, it dipped on the buyback from Vivendi, but it was at about 15 a year ago, and it's at 22 now. So I think you've got room for another $7 or $8 of appreciation. They get a discount to EA kind of unfairly. Their management has been considerably more consistent than EA's management. EA's management right now is great, but they're literally on their second or third quarter of being consistent. Activision's been doing it since 2005. I'd say, Bobby Kotick, the CEO, has always been really good. It's when he hired Thomas Tipple, who was the CFO at the time. Thomas has since moved up to be COO. That they have just been remarkably consistent. They never miss. I think that the knock on the stock is that they have 3 big franchises that people are afraid might decline in the future. One is World of Warcraft. That's legitimate. It's been around for 10 years, and it probably will decline. One is Skylanders. I don't think that's a legitimate concern. People were convinced that Disney Infinity would take share from it, and it did not last year. They both grew, so Disney Infinity did really well, but so did Skylanders. And the third is Call of Duty, which I think people just assume is getting old in the tooth and it's going to eventually crack. It cracked last year with the lowest rated game in the of the 10 that they have made. This one coming out this year is made by a phenomenal studio, Sledgehammer Games. Glenn Schofield and Mike Condrey run it. I think it's going to get the highest rating that any Call of Duty's ever gotten. It's the best one I've ever seen. So I think that they're all the way back on Call of Duty. I think Skylanders has a chance to grow, but very likely flat. It's unlikely to be down. And although I do believe World of Warcraft can decline, Blizzard has a bunch of other games. They have StarCraft, they have Diablo, they have a new release, a free-to-play game called Hearthstone that looks like it's just killing it. So I think that Activision's core business is probably slightly growing, and then they're launching a big game in September called Destiny that I think is going to be huge. So I think they get big earnings growth this year because of Destiny and because everything else is stable or slightly growing. Then next year we have Call of Duty in China. That's a big market. The biggest game in free-to-play in China that is similar to Call of Duty is a game called Crossfire, doing $1 billion a year, and it's 1999 technology. Call of Duty China is 2008 technology. It looks like an Xbox 360 game instead of like a 1999 PC game. I think that they're going to kill it when they launch that. So I love Activision. I think that you'll see 30 this year in 2014. I think you can put money there comfortably right now.
Okay, another one. I believe this one was taken. You're taking a little heat on when you were on the show last time. Walmart kind of getting into to the gaming business. GameStop maintaining your outperform rating and your $60 target here. This thing looks like it's starting to wind up here to go if it can break above $40.
Yeah, it's a tough stock because every day that passes, we are one day closer to their terminal value of zero. I mean, eventually there won't be physical media for games, and they sell physical discs. So I think that's true. I just don't think that happens for 15 or 20 years. I think that the short thesis is it happens in 5. And 10 years ago we heard the same thing, that discs are going away. We just got full game digital downloads for the first time, day and date, the same day as game releases this past Christmas. So we just started to see even the ability to do it. And even then, you're looking at probably less than 10% of game sales being digitally downloaded this year. I think the right way to think about GameStop is that there are 3 broad groups of people who buy games. One are people who trade games in, and that's about a third of all gamers. And if you trade games in, then you perceive that the physical disc you buy has a value. Think the average game traded in at GameStop is $12. That's how much you get for it. But I think that the gamers think it's more like 20, and that's probably because the more active guys trade in newer games. So people look at a $60 game and think, I'm really only paying $40 for it because I'm going to get a $20 credit for it when I turn it back in. The digital downloads are the same price, so that core trade-in guy does not think a digital download is worth as much, and so he's just not going to do it. That's a third of the audience. So I think a third never buys digital downloads unless the price is discounted, and economically it's just not going to happen. Another third are people that are wealthy, connected, have big hard drives, are lazy, and never want to get off the sofa, and digital downloads are compelling. So of course they're going to do it. So I think you're going to get a third off the bat who don't care and they'll download anything, a third off the bat who care very much and won't download ever, and then the third group is that group in the middle who may or may not value trade-ins, but more likely they like to give gifts, or they're collectors, or they like to give their games away to their friends when they're done playing them. And that big group in the middle will download sometimes and won't download sometimes. The moms who buy gifts have no idea how to buy the kid a digital download code and put that under the tree at Christmas. So they're going to continue to go to Walmart and buy gifts. The guys who like to collect aren't going to want to collect digital downloads. And you can see this with movie DVDs. People aren't downloading very many of those, even though the price is the same and there's no resale value, because people like to look at them on the shelf. They like to give them to their neighbors to watch. So I think that broad third in the middle that really are kind of indifferent, half of them will download, half won't. So I think your ultimate steady state for GameStop is 50% of all games end up being downloaded and 50% not. The good news for GameStop is that 1/3 who will never download a game is their core customer. So as more and more people download, that's going to cannibalize sales at Best Buy, Target, possibly Walmart, and the people who don't download continue to shop at GameStop. So they should gain share. We are looking for the market to grow 50%, 50, in the next 5 years. So if you take the state of the market last year, let's just call that X, and it grows by 50% to 1.5X, and then half of all gamers download, then half of 1.5X means that what's remaining is 0.75X for GameStop as an addressable market. However, they have about 30% share last year. If that grows to 40%, then their sales go from 30% of X, 0.3X, to 40% of 0.75X, 0.3X. So their sales run in place for the next 5 years. I think that's the right thesis on the stock. The GameStop hard disk, DVD sales are flat 5 years from now. In the meantime, they go up because the market probably grows a little faster in the next 2 years and then starts to flatten out. And they're supplementing their business by handling trade-ins of phones and tablets and other things. So I think you're going to see cash flow grow at this company. They have returned 5 $3 billion of cash to stakeholders in the last 6 years, 500 million a year. I think that number probably is 500 million this year, 600 next year, 700 the next year. Their share count's gone from 170 million to 113 million. I think it keeps coming down. So even when free cash flow flattens out, even when earnings flatten out, I think you're going to see EPS go up because they keep buying back stock. So I think this stock probably goes up for the next 3 to 5 years, but it's going to take a hit every time anybody mentions the word digital. I have a bunch of competitors who love to say GameStop's going away. There are a lot of guys on the buy side who like to say, I don't know anybody who buys anything physical. Everybody downloads everything because these rich guys don't talk to taxi drivers and doormen. I mean, real people buy physical media, and they rent physical media. So, I think that to assume everybody's got broadband, everybody has giant hard drives, and everyone's indifferent to download versus physical purchase is naive. But the stock's going to be volatile. I think it hits 60 before it hits 20.
And before I let you go, I know you're an active gamer. Have you hit any new levels and any new games and broken your old records, or you still just hanging near resistance?
I've been. You're just playing games? I've been playing a lot of free-to-play games. So I'm playing Candy Crush. I've been stuck on level 549 for 3 weeks, which kind of pisses me off. And I have spent money in the game. I haven't spent money on this level. I've only gotten close to beating it once, so I'm doing something wrong. I'll get through it. It apparently goes to 605 now. I've got 7 friends ahead of me, and one of them hit 605 the other day. So I've got a little bit to go, but I'm not in a big rush. And I played Pirates of the Caribbean, which is a Disney game. I just keep finding cheaters, so I'm whining to Disney about the cheaters. So we'll see if they do something about it.
Okay, well, Michael, thanks a lot for coming on. Michael Pachter, research analyst at Wedbush, getting into a few stocks that he follows with really in-depth analysis. Thanks, Michael. Have a good day.
It's my pleasure. Thank you.
All right. Talk to you soon.